This video will cover the topic of internal control systems. We're going to look at the auditor's approach to assessing these controls and systems at the client. For us to do this, we need to cover the following. Understand what a control is, the objectives of control systems, the limitations of a control system, the auditor's expectation of an internal control system, and finally, what the auditor does or their approach. A control is a procedure put in place to achieve company objectives. For any organisation to run well, it needs sound control systems in place. The key objectives of a control system should be to ensure accurate accounting records, to safeguard assets held by the organisation, to prevent and detect fraud, and to ensure an efficient working environment. There are limitations to internal controls including human error when making decisions and processing in a system, fraudulent collusion, staff working together to commit fraud, and abuse of authority, those officially making decisions within a system and overriding controls. ISA 315 tells us that auditors must understand the client's internal controls. For an auditor to assess whether a control system is strong or weak, they must have an understanding of what is expected of a control system. To give the auditors a benchmark of what is a good control system, the standard also gives us the 5 components of an internal control system. To help us remember these components, remember it is a crime not to have strong controls. The C is control activities, the R is risk assessment procedures, the I is information systems, the M is monitoring of controls, and the E is environment. The control activities include all of the individual procedures and policies that make up the system as a whole. These control activities within a system will ensure errors and fraud are reduced if implemented and followed properly. Examples of control activities include authorization, regular performance review, accounting reconciliations, segregation of duties, IT controls, and physical controls. Authorization or approval of transactions can assist in preventing non-business related transactions from occurring. It can also assist in areas such as cost control, as if approval is required by management for purchases, then review of the need for these items can be made before the order is carried out. Authorization should be made by a senior official of the organisation, and ideally, the higher the value, the more senior the approval should be. Regular performance review by an organisation will help identify potential misstatements by the client themselves. If the client performs its own analytical procedures, comparing their transactions with previous periods and budgets, they can highlight unusual trends or differences which can then be investigated internally. They can also compare figures to key competitors to keep an eye on their market share and performance. Accounting reconciliations are a brilliant way to identify misstatements in the accounting records. Regular accounting reconciliations ensure misstatements are dealt with on a timely basis and help identify if there is a problem with the control system as a whole. The key accounting reconciliations are bank, receivables, payables, and inventory control reconciliations. Differences highlighted from this work is then investigated so that potential misstatements can then be corrected before the auditor arrives to complete the audit. Segregation of duties is the sharing of responsibilities within a control system. Imagine one employee responsible for everything within a control. This increases the risk of errors and potentially the risk of fraud also, as there is no supervision or checking one another's work. To have more than one employee working within the system, sharing the role and even rotating duties increases accuracy. IT controls cover a range of activities to protect the computer systems being used. They also ensure other control activities are managed. Examples include backup procedures of data, software installation and update procedures, security including passwords, sequence checks and batch total checks when posting transactions, and authorization limits to ensure transactions are valid. A good computer system should include these control procedures. Physical controls are present to ensure access into the system and the business itself is authorized. These controls include restricted access such as swipe card or code access into the warehouse, CCTV, and alarm systems. Each control activity is in place to protect the entity, which is made up of many control systems. Now we have covered control activities, let's move on to discuss the remaining 4 components of an internal control system. Risk assessment procedures carried out by the client should be to identify and manage potential business risks. The level of risk assessment will depend on the type of organisation, as for example, smaller business with standard systems will have less risks than large, complex, highly regulated businesses. If a business reviews and manages its own risks, it will reduce the risk of misstatements caused by error and fraud. Information systems are an organised system for the collection, organisation, storage and communication of financial information. It includes both computer and manual systems, and the auditor should be able to understand the system and how it works with the help of manuals and staff communication. Monitoring of control systems is important to ensure the controls are working effectively. As an entity progresses, their need for internal controls may change, and therefore the organisation must react to these changes on a timely basis. The internal auditor is useful here, as they are best placed to take on this role. Finally, the control environment. This is the overall environment of the entity. For there to be a strong control environment, management attitude, awareness and actions are important. If the management are enthusiastic about ensuring control systems are strong, this will encourage the entire organisation to have the same attitude. Having an internal audit department in place is an indicator of a strong control environment, as they will be reviewing and implementing control systems as part of their role. Ensuring the correct people work in the organisation is also important, so having good recruitment and training procedures is also a good indicator. Now we have discussed the 5 components of an internal control system that the auditor is looking for, we can now discuss how the auditor reviews these systems to decide whether they are satisfied with their effectiveness. The auditor has a step-by-step approach when reviewing control systems as part of the audit assignment. The aim of the auditor is to assess whether the internal control systems would ensure material misstatements are identified and corrected. If control systems are poor, this increases the risk of material misstatements being within the financial statements. Firstly, the auditor needs to identify and understand the control system. For example, the sales, purchases, payroll, inventory, cash and asset systems. They can use methods to help understand, including inquiry with management and staff, inspection of documentation such as manuals, and observation of the control system itself and those working within that system. The next step is to document the system. Auditors must prove that they understand the system, and so by documenting and including within the audit file, they have gathered sufficient appropriate evidence on this. There are various methods to document the system, the most popular being detailed written notes or flowcharts. Detailed notes are easy to put together, but can be difficult to identify any missing controls due to the level of detail. Flowcharts can be easier to spot any deficiencies, however they can be more time-consuming, as detailed notes may also be needed in order to prepare them. Either method then gives the auditor an understanding of the system for their audit work. The next step is to assess the system. The auditors must initially identify whether the internal control system is strong or weak. Whilst understanding the system, talking to staff, observing and inspecting documentation, the auditor will have an idea of what kind of system they're reviewing. In addition to this, The auditor can send out internal control questionnaires to the client's staff to get feedback on how the system operates. There are two types of client questionnaires the auditor can use: internal control questionnaires, or ICQs, and internal control evaluation questionnaires, or ICEQs. Internal control questionnaires are a series of questions on the system that require a yes or no answer. They are therefore quick and easy for the client staff to fill out. For example, a question could be: does the payroll system require a password to access staff data? An internal control evaluation questionnaire requires a little more feedback. The question would be formatted differently. For example, is the payroll system secure? And please explain your answer. This type of question can therefore give you some more understanding of the system and who operates within it. Auditors would now have an idea as to whether the control system is strong or weak. If the system appears to be strong, the auditor must gather further evidence to prove that they agree with this conclusion. This is in the form of control tests or control procedures. A control test is a test that gathers evidence on whether the system is effective. These tests are carried out by the auditor, and all evidence collected is then filed on the audit file to back up their conclusions. Once again, using the methods inquiry, inspection and observation are useful when designing control tests. The objective of every control test should be to prove whether the control works. An example could be when reviewing the security of the payroll system. With the client's permission, attempt to gain access to the payroll system without the password to ensure only authorized access is possible. Or, inquire about the security procedures over the payroll system, including the type of password needed and whether it is regularly changed. Both of these control tests would identify if the payroll system's security is appropriate. Once the control tests have been performed, the auditor must conclude whether they agree with the earlier evidence that the control system is strong, or whether they disagree and the system is weak. This is critical for the audit, as it then decides how much further audit work is needed to form the audit opinion on the financial statements. The next stage of the audit process is substantive testing, and this is where the audit tests or procedures are performed to identify if there are any material misstatements within the financial statements. If the auditor has concluded that the internal control system is weak, there is a greater risk of material misstatements present. They must increase the level of substantive testing required. The sample size of transactions being tested would be increased, and more procedures would be designed. This would mean more time spent on the audit also. If the control systems are strong, there is a smaller risk of material misstatements, and therefore no need to test as many transactions. This means smaller sample sizes and less time needed. In addition to control testing and deciding how effective the control systems are, the auditor has a responsibility to report any issues found with the client. If deficiencies in the internal control system have been found, the auditor reports to the client along with recommendations on how to improve the system. This is discussed in more detail in another video. To conclude, internal control systems are in place to achieve company objectives. Control systems have limitations, and so the auditor cannot rely wholly on a strong control system ensuring no material misstatements are present. The auditor is looking for 5 components of an internal control system: control activities, risk, information systems, monitoring and environment. And they follow a step-by-step approach to conclude whether the internal control system can be relied upon. I hope you found this video useful. Thanks for watching. This video will take you through what the auditor does to identify and then communicate internal control deficiencies to the client. We will need to cover the following: how the auditor identifies deficiencies, the management report, and the timing of communicating deficiencies. When performing the audit work, auditors must review the control systems that relate to the financial statements. These can include the following systems: sales, purchases, inventory, payroll, cash and bank, and non-current assets. Each system must be reviewed and understood by the auditor. They then document the system for their own evidence and begin the task of deciding whether the system could cause potential material misstatements. As they are performing this work and testing the systems, they will identify if there are any issues with the way the system operates. Using their skills and experience, they may notice control activities missing within the system that could cause problems. Time taken to understand the system, review documentation, and use internal control questionnaires gives the auditor the opportunity to find deficiencies within the system under review. Here are some examples to help you understand what is meant by deficiencies. For a sales system, the auditor may discover that discounts for customers are manually input onto the face of the invoice by the sales clerk. The issue here is that the discount may be input incorrectly by the clerk. Human error is always an issue when manual input into a system is present. This could lead to misstatements in the sales and receivables balance. This scenario could also lead to the sales clerk inputting unauthorized, inappropriate discounts onto the invoice. For every control deficiency found, the auditor has an obligation to recommend how the entity could improve that control. A recommendation for the control deficiency that we have just discussed could be to have authorized discounts included on the customer account on the system so the invoice is automatically updated with the correct amount. For a purchase system, a control deficiency could be where the warehouse receiving the goods delivered agree the goods received note to the physical goods and then file a copy of the GRN and send a copy to the accounts department. There is evidence of good controls here as they do review the goods received with the goods received note. However, they do not review the original order to see if the goods received are what was originally requested. The goods may have not been ordered and the entity could be invoiced for goods not required. A recommendation would be for every delivery into the warehouse to agree the goods to the GRN and the purchase order before accepting the goods. For inventory systems, a control deficiency could be that they do not mark inventory when it has been counted during the inventory count. If not marked, the inventory could be counted again or missed altogether and not detected, which could cause a misstatement in the inventory balance. A recommendation would be to mark the areas of the warehouse where counting has been completed. This way it will be clearer to see if areas have been missed or to not count them again. For a payroll system, a control deficiency could be the monthly payroll report is not reviewed. If the balances are not reviewed for each payroll run, there could be a misstatement not detected. The recommendation should be to ensure a responsible official, such as the payroll manager, reviews the payroll report and compares the balances to previous months to identify potential misstatements. Evidence of checking, such as a signature, should be present. For cash and bank, a control deficiency could be that the cash is not banked regularly. If cash is held at the business and builds up, it increases the temptation of theft. A sensible recommendation, therefore, should be to regularly bank money. This task should be undertaken by more than one employee, and rotation of duty should also reduce the risk of fraud and error. In a non-current asset system, a control deficiency could be that the request for a new asset is not approved. If not approved, assets could be ordered for personal use, therefore the risk of fraud is higher. All asset requisitions should be approved by a senior official. Decisions on purchasing of assets should be made with the reference to budgets also. Once the auditor has identified control deficiencies, they will then collate them and include within a report to the management of the entity. This report has various terms associated with it. You may hear it called any of the following: a report to those charged with governance, a management letter, and a management report. The auditor has ISA 265 to give guidance on communicating deficiencies. It tells us that significant deficiencies should be communicated in writing to the entity's management. This is usually prepared in a letter or report format. The management report should be addressed to the directors of the entity. It will detail all of the deficiencies found by the auditor during their audit. They will also explain the impact of the deficiency and a recommendation. The deficiency should be a clear description of what is wrong. The impact should be an explanation of what could happen if the deficiency is not addressed by management. For example, as we've already discussed, deficiencies could lead to theft, errors in the accounts, and unnecessary costs. The recommendation should be a realistic suggestion to improve the specific deficiency. This is to help the client improve its control systems for the future, which will assist future audits if it is then implemented. In addition to outlining deficiencies, the auditor must give specific information regarding the evidence being provided. Within the report, they will explain that the report is not a comprehensive list of all deficiencies. The deficiencies are only those found during the work of the auditor, and there may be more that have not been detected. The report and the information within it is for the sole use of the company. They should not disclose anything within the report to a third party without written permission from the auditor, and no responsibility is assumed to any other parties. The timing of the management report is agreed at the beginning of the audit assignment, before work commences. Management reports are usually given to the client at the end of the audit process, once the audit report has been prepared. Often, the client will have a meeting with the auditors and discuss these deficiencies to enable them to clearly identify what needs to be done. In summary, auditors use their experience and feedback from the client to understand the control systems, and this enables them to identify deficiencies. They are required to identify deficiencies and recommend improvements to control systems, and this is laid out in ISA 265. There are various control systems that relate to the financial statements, including sales, purchases, inventory, payroll, cash, and assets. Once deficiencies are identified, they are included in the management report, along with the impact and recommendations. The management report is usually communicated at the end of the audit, once all of the audit work is complete. I hope you found this video useful. Thanks for watching. This video is going to cover the key control systems or cycles. It has been prepared to help you understand the stages of the key control systems and their objectives, the risks within the systems, and the controls that will help reduce the risk of the problems occurring. The control cycles we are going to cover are the systems linked to the financial statements. They have an impact on whether the financial statements are true and fair, and are the sales, purchases, assets, inventory, payroll, and cash systems. For each system, I will outline the stages of the system and examples of the objectives, risks, and controls at each stage. We're going to start with the sales system. It has 5 key stages where controls should be designed to ensure mistakes do not happen. Stage 1 is when the order is received. Stage 2 is when the goods are dispatched. Stage 3 is when the invoice is sent. Stage 4 is when the transaction is recorded in the financial statements. And stage 5 is when the cash is received. Stage 1, when the order is received, is usually in the sales department. It could be taken over the phone, via a website, or by email. A sales order should be produced for each order received. The objective of controls at this stage is that all orders are processed, and customer orders are only accepted for customers who can pay. An example of risks are: an order is taken for a customer who has exceeded their credit limit, or the order is not recorded properly. Controls to be put in place could be access to the customer account where the credit limit can be reviewed when the order is taken. Stage 2, when the goods are dispatched, is usually in the warehouse. A delivery note or goods dispatch note should be produced. The objective of this stage would be for goods dispatched to be on time to the correct customer and all sent out. An example of a risk is that goods sent out are for the wrong quantity. Controls put in place could be the dispatch team must agree the original order to the dispatch note and the goods to indicate with a signature that this has been checked. Stage 3, when the invoice is prepared and sent, would occur in the accounts department. The objective would be all goods have been invoiced for and all are invoiced with the correct amounts. An example of a risk is a customer was not invoiced with the right product, and controls put in place could be a copy of each dispatch note is sent to the accounts department sequentially numbered. The accounts team should review the dispatch note when preparing the invoice. Stage 4, when the transaction is recorded, would also be in the accounts department. The objectives would be to include all invoices on the system for the correct amounts. A risk would be that sales are not recorded accurately or in the correct period. And a control would be to prepare invoices with sequential numbering. On entering the invoice, to use that reference and regularly check the system to ensure the sequence is not missing an invoice number. Stage 5 is the payment from the customer. The objective is to ensure cash is received on a timely basis and recorded correctly in the correct customer account. A risk could be that the cash is not paid on time, and a control would be to having a member of staff perform credit control procedures such as reviewing the sales account regularly for debts that have reached their payment deadline and chase customers for payments. The purchase cycle has 6 stages where controls should be in place to reduce the risk of fraud and error. Stage 1 is the requisition stage. Stage 2 is where the order is placed. Stage 3 is where the goods are received. Stage 4 is where the invoice is received from the supplier. And Stage 5 is where the invoice is recorded on the account system. Stage 6 is where the payment is sent to the supplier. Stage 1, the requisition stage, is where the business or division within the business will recognise the need for more goods. A requisition note will be passed to the purchasing department detailing the supplies needed. The objective is to ensure goods are requested and are for business purposes. A risk could be the requisition note may not be received by the purchasing department and the order not made. A control could be requisitions are made by email to the purchasing department who must respond when they have made the order. Stage 2, the ordering stage, takes place in the purchasing department. There should be a purchase order for each order made, which details the goods ordered, the quantity, price and supplier used. The objective is to ensure suppliers used have been checked for reliability, quality and price, and orders made considering disruptions to production if not delivered on time. A risk could be a supplier is used who is not reliable and delivers late, leading to a delay in production. A control could be to select a supplier from an authorised supplier list. This list could be authorised by senior officials and regularly reviewed to ensure suppliers' quality and price have not changed. Stage 3 is when the goods are received. This is usually in the warehouse where a delivery note or goods received note will be prepared. The objective is to ensure only goods ordered are received and accepted and received on time. A risk could be that goods received have not been ordered by the company, and a control would be for every delivery the goods should be inspected and agreed to the delivery note and a copy of the purchase order. This should then be signed by that staff member. Stage 4 is when the invoice is received. This will be in the accounts department. The objective is to ensure invoices received are for goods received. That is for business purposes and for the correct amounts and products. A risk could be that the invoice is not for goods ordered, and a control would be each invoice received should be matched with the corresponding purchase order and requisition note. Any that have missing orders should be investigated with the supplier. Stage 5 is the recording of the invoice on the accounting system. The objective is to ensure all invoices are recorded and they are recorded accurately and in the correct period. A risk is that invoices may be missed and payables and purchases understated. A control could be ensure each invoice when received is allocated a sequential invoice number. The sequence should be checked regularly on the system to ensure no invoices have been missed. Stage 6 is the payment to the supplier. The objective is to ensure payments are made for the correct amounts, for goods ordered and received, and made on time. A risk could be the payment is not made and the supplier may no longer grant credit. A control could be to have regular payment runs and to review the aged payables list regularly for older debts and ensure they are paid on time. The control system for assets would work in the same way as the purchase system. There would be some additional controls required due to the size of the values being spent on these items in comparison to the standard goods and services. One would be the authorization of costs. This would need to be approved from a much senior level of management than your standard purchase. The other would be the use of the asset register. This spreadsheet will record all details in relation to the assets in the business, including the date, cost, depreciation, carrying value, location, and disposal date and proceeds. This should be updated and reviewed regularly and compared to the accounting system to ensure there are no errors. The inventory cycle works very much like a cycle. The business will make an order for inventory. The inventory will be received in the warehouse. Sales will be made. The inventory will then be dispatched to the customers. So more goods will be needed and they can make an order for more inventory. We have seen many of the controls already in this process as the inventory cycle is blended with the sales and purchase cycles. Looking more specifically at other inventory controls, what we haven't yet seen are storage controls for inventory and controls over monitoring the amount of inventory in the warehouse, or inventory counting. When the business is storing its inventory, the key objective is to keep it safe and maintain its value. The risks are goods could be stolen, goods could be damaged, and goods may become obsolete. Examples of controls to reduce the risk of theft are increased security such as CCTV, alarm systems and security guards, restricted access to the warehouse, for example limited exits, and only authorised access, for example swipe card access or fingerprint recognition at entry points. Examples of controls to reduce the risk of damage could be practical packaging of inventory items, shelving for organised storage, and training for handling of items. And examples of controls to reduce the risk of obsolescence are a first in first out system for items being dispatched, not to hold excessive amounts of inventory, regular monitoring of aged inventory list for old slow moving items, and special offers potentially to shift items that are not selling faster. The inventory counting process requires tight controls for it to be effective. The external auditor will always review this control carefully, as if there are deficiencies, it could lead to material misstatements in the inventory balance. This would affect the statement of financial position and the P&L. If the company carries out a year-end inventory count, the auditor will attend. If they carry out several counts during the year as a continuous counting process, the auditor will attend as sample. There are elements of the account that are important to have controls. These are the people counting, the admin or paperwork, the count itself, and the end process of the count. The people counting the inventory should be objective. They will be staff members but should not be the warehouse staff. This reduces the risk of theft being hidden by those who are in a position to steal. The counting should be carried out in teams of 2 or more, and the process should be supervised by someone senior, for example the internal audit manager. There are 2 key pieces of paperwork, the count instructions and the count sheets. The count instructions should be clear and easy to follow. They should be given out before the count, and the staff should be briefed so they fully understand what they are to do. The count sheets should be sequentially numbered. Spare sheets for inventory found not on them should also be pre-numbered, so sheets cannot go missing. These sheets should include the product details such as the description and code, but should not include the quantities as per the system. This stops count teams just agreeing with the number. During the count sheets should be divided between the teams. The sheets should be signed out so they know who is counting which area. Count staff should inspect inventory for evidence of damage which could affect the valuation and flag this on the count sheets or to the count supervisor. There should be a systematic, organised count to reduce the risk of areas being missed or counted twice. Areas can also be marked once counted to reduce the risk of mistakes. When recording the quantities on the count sheets, they should mark in pen and not pencil. This will identify if any changes are made after the count. At the end of the count, the sheets should all be signed back in and the sequence checked to ensure no inventory sheets are missing. These are then used to calculate the valuation of inventory to include in the financial statements. External auditors would take a copy of the count sheets as evidence before they leave if attending. The payroll cycle identifies important stages where controls should be present. Stage 1 is where fixed and variable data regarding the employees is recorded on the payroll system. Stage 2 is where the calculations are made by the system. Stage 3 is where the outputs from the system are created, such as the payroll report and the payslips. Stage 4 is where the payments are made to the employees and the government. Fixed data regarding employees includes bank accounts, hourly pay, holiday days, etc. Variable data would come from the clock cards or timesheets in the form of hours worked to help calculate pay. This data needs to be kept secure, so locking away this paperwork and only allowing authorised access is important. The other risk is that information is open to manipulation, for example including fraudulent working hours. Controls to reduce this risk include CCTV over the clock card area as a deterrent, authorisation of overtime from a senior official, and supervision of employees. The calculations made by the payroll system must be monitored regularly as there is a risk of misstatements. The software used should be up to date and regularly checked for updates. Having updates via the internet reduces the risk of these being missed, for example. Also, regular checks on calculations. Taking samples and recalculating the pay and deductions would identify if the system is working properly. The system itself should also be secure. Ensuring only authorised access is permitted will avoid the risk of individuals changing pay or setting up fake employees. Therefore, secure password access is important. The payroll report and the payslip should only be accessed by those authorised to see them. Therefore, locking payroll reports away is a good control, and sending payslips straight to employees' home addresses would avoid this information getting into the wrong hands. The payroll report should be reviewed by the payroll manager. Comparing to previous months, the previous year, and budgets will identify if something looks unusual. Evidence that this has been carried out, such as a signature and date, would enforce the control. Finally, Stage 4 is the payments. Payments to employees and the government must be made on time. Therefore, setting deadlines for submissions such as overtime should be in place. The correct amounts must be paid and only to valid employees. Therefore, having a senior official, such as the payroll manager, review this information from the payroll report and the payment sheets will reduce the risk of an incorrect payment. Cash controls are our final system to review in this video. The stages of a cash cycle are: Stage 1, a payment for an item is requested. Stage 2, the payment is authorised. Stage 3, the payment is made and receipts come in. Stage 4, all movement in cash is then recorded in the books and records. The objective for controls over cash are: to ensure cash is kept to a minimum at the company premises. Payments and transfers can only be made with authorisation from a senior official. They are for business purposes only. Cash is protected from theft and banked regularly. An example of some controls to achieve the objectives include: using an impressed system for petty cash, having a manager's signature for all payments made, regular review of the cash book and petty cash book by management, locking away cash in a safe at the premises, and regular banking patterns using different staff taking different routes to the bank to avoid theft. We have now reviewed the key control systems that connect to the financial statements of an organisation. For each system, a good understanding is needed of the objectives, risks, and effective controls that a company should have in place. The specific controls within a control system will reduce the risk of fraud and error. They will not eliminate the risk, as controls have limitations, as we have discussed in another video. The stronger these control systems are, the less chance of material misstatements being present. This in turn assists the external auditor. Audit risk will be reduced, making it more straightforward to form their audit opinion. I hope you found this video useful. Thank you for watching.